Oh, okay. Well, thank you so much for everyone for joining us today. I'm really excited to be here. Just to start by introducing myself, my name is Olivia Goldstein. So I'm an entrepreneur. My company, RepHike, was an early investment through the Starfast Accelerator. And I've now exited and actually joined the Starfast team for Fund 2. I'm really excited to be here today with Chuck Stormon and Nasir Ali. So Chuck and Nasir have been investing together for more than a decade. And prior to launching Starfast Fund 2, they've invested in nearly 60 companies through the Starfast Venture Accelerator and the Seed Capital Fund of Central New York. And now Starfast Fund 2 finds them making bigger bets on companies that are outside of normal VC hubs. And today we are here to learn about how they find hidden gems. So before we dive into some of the questions, we're probably going to spend about 20 minutes or so just asking Chuck and Nasir a series of questions. After that, we'll open it up to Q&A. So if anybody has any questions along the way, feel free to pop them in the chat and we can go through them at the end. So, all right. Chuck, let's start with you. You are a serial entrepreneur turned investor, and I'm curious, so how did your experiences as a founder really shape the thesis behind Starfast?
Thanks, Olivia. It's a real pleasure to speak with you and the rest of the folks here today. As a founder of a company in upstate New York, I had the experience that many upstate founders have, which is at some point in the growth of the business, I was looking for capital. And with my first company, capital was very difficult to find. The first time I raised capital in upstate New York, I held 150 meetings. The attempt was to raise $1 million. I met with all of the high net worth individuals that everyone in my network could assemble. And I think we had some pretty extensive networks. But because I was a high-tech investor, we didn't attract the $1 million. In 150 meetings, we raised $158,000. And that was not net of costs. There were costs to all this fundraising as well. Ultimately, to make that company successful, I ended up finding investors in Silicon Valley, in St. Paul, Minnesota, in Japan, and in New York City. And overall, we raised over $25 million. The company was very successful, and we had a great couple of exits. But why did I have to go all over the world, literally, to find the capital I needed when there's so much capital available right here in upstate New York? The reason we founded Starfast, one of the big reasons, was to make sure that nobody ever had to have that experience again, right? That we would be able to bring truly world-class venture capital to our region and to other regions around the country, so that founders could build great businesses exactly where they are.
Wow, that's a fascinating story. Thank you for sharing. So Nasir, you've been building the ecosystem in upstate New York for more than a decade and have helped start both multiple angel and seed funds. So I'm curious, how did that experience really inform your decision to create a VC fund?
Yeah, thanks, Olivia. It's, looking back in 2004, when I first moved to Syracuse, it was a little bit of a culture shock because up until then, my life had been pretty much along the Amtrak corridor from DC to Boston. And I just took it for granted that if somebody had a great idea and they wanted to build a business around it, there were more than enough people to, invest in them, to help them grow and so on. And when I moved to Syracuse in 2004, the business community really wanted to get that kind of ecosystem started, but there were very, very few people who had the experience. So we started running a set of experiments to see how we can get more, companies that are scalable, that can have an impact on these communities the way Carrier and Xerox and Kodak did, started locally. But what we found was there was no shortage of innovation, and Chuck's example is very much on point. there are many, many, many people who have the brains and the capability and the understanding to build amazing businesses. What was missing was the initial seed capital and the initial, here's what we can do to help you conversation that I had up until then just taken for granted was the way everything operated. And building out the ecosystem has been very much about how to build greater connectivity between first-time entrepreneurs and experienced entrepreneurs. And it's not easy because we're not all in 10 square blocks in Chelsea. We're spread over, a geography that takes hours and hours to traverse. So, and then the most important part is who's willing to write that check. And what we realized was that the best way to go about doing it was to start seed capital funds, where people make the commitment up front to write that check. And it's not like they're just meeting people and then having to decide after that. If they make the commitment first, then the money flows a lot faster. And that's been, a big part of what we were doing. With my partner, Martin Babinek, we launched Upstate Venture Connect as a not-for-profit in 2010. And it's been an incredible journey to build a 20,000 person network that is now ready to react and respond and help entrepreneurs with not just capital, but networks and introductions.
Yeah, that's amazing to see how far you've come. Chuck, the traditional way for founders usually to meet venture capitalists is to find a warm referral. But many founders that are outside of New York City, Silicon Valley, they just don't have the networks to get those connections. So I'm curious, how does that founder VC connection happen outside of the major metro hubs?
Well, that's a great question, Olivia, because this, of course, is one of the biggest problems that a founder whose company is in need of some financing has to solve. A lot of them have traditionally solved it by going through the process of building a network from scratch. And that's very difficult and time consuming. And I can tell you there are two kinds of misadventures that can occur in that process, and then how we solve that or how we help them avoid those misadventures. One is that they may get introduced to a venture capitalist in one of the hubs, let's say Manhattan or Silicon Valley. And this happened to me. I got introduced through my own networking efforts to some very credible VCs in Silicon Valley, which was very helpful because I was building a semiconductor company. But I was told that in order to be successful, I'd have to move my company to Silicon Valley. And that if I was willing to do that, then the venture capitalist would invest in my company. So my founders and I sat down together and said, well, quality of life's important to us. And we know if we move to Silicon Valley, we'll have a great career, but our quality of life will change dramatically. And we're all outdoorsy people. We like skiing and hiking, and we like to go to the Adirondacks. We like the proximity to New York City of living in upstate New York. And at the time, we were just starting our young families, and we all kind of looked at each other and said, we don't want to move. So we said no to that VC, and there was no money from that VC. So that's a misadventure that a lot of entrepreneurs have in common when they're connecting to traditional VCs. The other kind of misadventure I have also avoided, which is you encounter people along the way who have plenty of money and they like your company and they don't want you to move, but they want control of your business at the very first funding round. And seed stage funding usually does not involve the founders giving up controlling interest in the business. It's usually at that initial investment round, the founder or founding group can keep more than 51% of the company. But there are a whole lot of investors who will only invest, individuals who will only invest if they can control the business that they're buying a piece of. So again, I avoided that misadventure by saying no. A lot of startup companies, they get frustrated and they finally say, okay, this guy's going to control the company or this woman's going to control the company, but at least we get the financing we need to grow our business. So again, the new way to do that with a venture fund like Starfast around, as Nasir said, we've built a network of 20,000 people at the broad base, and then a few hundred at a much more intimate level that know exactly the kinds of companies we're looking for, and they're out there searching them out and making introductions for us to companies in Charlotte or Phoenix or Columbus, Ohio, or anywhere in between, so that we can begin a conversation, usually with a Zoom call, usually reviewing a PowerPoint, and try to see if there's a fit to develop a relationship where we can put seed stage funding into a company without demanding outrageous terms, state-of-the-art deals in places that usually don't have access to state-of-the-art deals. That means we get access to world-class companies that most VCs don't get to see.
Mm-hmm.
So I hope I answered your question. I hope that wasn't too long.
No, that was great. And it's amazing to think if you would have just said yes to that VC, how different your life would have been. So grateful you said no.
I'd probably be a lot richer financially and a lot poorer in a lot of other ways.
That's true, yeah. So Nasir, let's say you find a great founder with a world-class business, but they are based in Charlotte, North Carolina, or Rochester, New York. Can you share a little bit about what the economics are of investing and growing and how they're different for this founder versus their counterpart in like San Jose or Palo Alto?
Sure, happy to. I think, so it's funny because we do have portfolio companies in both Charlotte and Rochester. So very, very apt question, Olivia. And we also have companies in Scottsdale, Arizona, and Salt Lake City, and every place else in between. So the reality is that there's two issues at work here. Number one is that when these companies are speaking to coastal VCs, there's a different scale-up model in terms of the finance projections that they have to put together. And those don't really match up between New York City and Rochester, New York, or Charlotte. Not only is the cost of living and infrastructure lower, right? There's also the labor market is very different. And you are able to, you're not constantly competing with the churn created by another $1 billion of venture capital being deposited into bank accounts every week, which is really the case in places like San Francisco and New York City and a few other hubs. You know, it's kind of scary to think that we're at an all-time high in terms of how much venture capital has been raised over the past 2 years, and yet 95+% of it is only going into 10 metro areas, and more than half of it is going into 2. So the, you know, that has its own impact on increasing or inflating the cost of building a business, because now you don't just have to compete in terms of the base cost, but you also have to compete in terms of having to manage the churn that comes from people switching jobs all the time, always in search of the bigger, better, shorter thing that's going to give you slightly more stock options and a much bigger base salary kind of thing. So what we see is that, you know, the mechanics and the expenses of building companies outside these VC hubs is very, very different. It's harder to look for the right talent, but you can also guarantee that the talent has a quality of life that is very, very different from struggling in a big city. And all of that, when you add in the churn, means that less churn means that people stay longer, they're therefore learning faster, they're much more productive, and dollar for dollar, you're getting more value in terms of what they can do for your company, right? And then at the end of the day, when it comes time for an exit, the exit values are really driven not by location, but by how fast your company is growing and how big it's become, which is a function of the market. And that means that you can actually, you know, invest and grow very efficiently and then reap market value, compared to all the other companies that may have raised far more funding and where founders and VCs, early stage VCs, have had far more dilution.
Mhm.
So it's a very different game.
Yeah, so true. All right. So the last question I have is, I'm curious to get both of your answers if you're okay with it. So what are some of the exciting opportunities you're seeing, and what do you think is needed for founders outside VC hubs to realize their full potential? So
Great
Chuck, maybe you
question.
can
I'll jump in first. And Olivia, one of the big opportunities right now where companies are making a lot of headway, and where we as an investor have a strong interest in investing, is in the area of artificial intelligence.
Mhm.
We're at the point now where artificial intelligence is becoming a factor in every industry. And we're seeing it in two in particular that are extremely interesting. Were actually our first two investments that we made in Starfast Fund 2, which is the fund we're operating right now. One is artificial intelligence applied to the quality of information that's out there on the internet in terms of misinformation and disinformation. A company out of Rochester, New York, has come up with a very important artificial intelligence solution for being able to track misinformation campaigns, to locate their sources, and to figure out how to mitigate them. So that's useful not only for governments who are trying to keep their elections from being undermined, or their vaccine campaigns from being undermined, any kind of governmental information that's important for public health, but it's also important for big brands. And those big brands are really looking at things that would undermine their brand position or their messaging. So the company that out of Rochester that's doing that is called Blackbird. Blackbird.ai is their website. We're proud to have been announced as participating in their recent round. And we're extremely excited about the opportunities for that company.
Mhm.
Nasir may have some more to say about why Rochester is such a perfect place for that company. But I'll just mention one other AI company that we've invested in, which is called Signos, SIGNOS.com. The founder's actually from upstate New York and has relocated to San Francisco. The company uses artificial intelligence to deliver to an average user in an iPhone format the ability to monitor their blood glucose 100% of the time, using a very easy glucose monitor that can be put on the arm like a Band-Aid.
Mhm.
And using AI, and it gathers information about how the individual person's body responds to the food that you eat, and then gives advice about how to achieve your weight loss or athletic goals. That company is also extremely exciting. It's on a tear. And again, we're very proud to be early investors in Signos.
Oh, that's great. Nasir, do you have something to add?
I think Chuck covered two of the most exciting companies in our portfolio. And I think digital health and AI and cybersecurity are just here to stay. There's tons of opportunity, but there's also opportunity in construction and manufacturing. These are all industries that have lagged in terms of adoption, and the last 2 years have shown people the perils of not being at the forefront of using technology. So we've got a number of very exciting opportunities that we're looking at. I just want to close with an observation that I heard from a friend who actually used to run the endowment for one of the big colleges in upstate. About investing in venture capital, and how when they did an analysis of all the different VCs that they were invested in, what they found was that they weren't getting real diversification, because all the same VCs in the same locations tended to follow each other into the same deals. And so you might think that you invest in 3 or 10 VC funds and you're getting 200 companies, but the reality is you might get less than half of that. Because what it all comes down to is that you're just sitting on the same cap tables as an investor under different VC funds. So we have a really unique opportunity through our new fund, and we're excited to be working with investors to deliver to them what they're unlikely to find elsewhere.
Could I just add on to what you said, Nasir? You made a great point about diversification geographically. You're right that all of the coastal VCs are investing in the same locations, and Starfast is an opportunity to diversify your portfolio in the rest of the country, the interior of America, or the heartland. But there's another aspect of diversity that I'd just like to bring up. We're not normally considered a diversity fund, so to speak, is in that, we don't lead with that notion. But if you look at our track record over the last 9 years, 73% of the investments that we've made have gone into companies that have been led by women or African Americans or South Asians or other so-called diverse demographic groups. And so that's a really striking number. And it's another aspect of diversity and diversification. So geographic diversity and demographic diversity are really, really strong with Starfast. I just wanted to highlight that.
Thank you so much to everybody for tuning in today and joining us. We hope you all gained and learned something, as I know I did. And thank you so much, Chuck and Nasir, for your time.
You're very welcome.
Olivia.
Thank you.
Thanks, everybody.